And for his insights on the global markets and economies, I'm now joined by Professor Patrick McNutt from the Manchester Business School. Patrick, stocks started the fourth quarter on a sour note, we could say. So is the 6-month rally over?
I think what we're seeing, Jennifer, good morning to you, is an ease in the Asian stocks and certainly an ease in many of the European stocks. What we're waiting for is for the Dow Jones just to break the 10,000 barrier. And once that happens, then we can be more conclusive as to what the future looks like for the end of this quarter. But I'd agree, we are seeing some easing on the stocks. But remember, the Dow Jones only hit 10,000 10 years ago, this month actually. So we have another few months to go before we can actually see the end of this bull rally at the moment.
But has the market gone far ahead of the economic recovery?
I don't think so, because if you look at all the main numbers on the boards, they've all returned to levels where they would have been a few years ago. For example, the Dow Jones would have to get to 13,000 to match the increase in inflation. So the Dow Jones has a long way to go yet. So it really hasn't yet reflected any sort of bull market. So it's not overly confident. I'd expect more trend in these indices over the next couple of months, Jennifer.
Let's now talk about the housing sector in the U.S. Is the slump in U.S. home prices bottoming out?
We have to wait now for today to see the unemployment numbers in the U.S., but it looks like there might be another few months in these house prices. There's 15 million Americans unemployed. Today there could be 9.7%. That's quite a high number for the U.S. That will impact a lot on the housing sector, and I rather suspect that there's still a continued decrease in the house prices for another quarter.
What could push them up or perhaps cause another slump?
Well, it depends on two things. It depends on numbers employed, whether or not they can retain employment, or indeed it depends on the interest rates. Now, it depends what the Fed's going to do. If interest rates remain low, that might help a sustained recovery, but indeed if they raise interest rates to support the dollar, that could really push the slump even further into 2010, quarter two.
We've been mentioning the jobless rate or unemployment. U.S. unemployment rate now stands at 9.7%. What are your expectations for the Friday jobs report?
I think tonight, when we hear it here in Asia, it'll probably be an extra 200,000. I think is going to be added to the jobless number. So we'll probably see that number going up. The magic number of 10%, which is a terrible figure to have, it indicates the extent of the downturn in the U.S. 15 million is a high number, and I suspect that we might see 10% unemployment rate by the end of this year.
Okay, former Fed Chief Alan Greenspan expects the U.S. economy to grow at around 3 to 4% annual pace in the next 6 months before it actually slows down. What's your prognosis?
I'm looking into second quarter 2010, and part of that is that in June 2010 we're going to see the Canada summit of the G20. And between now and then, you're going to see a devaluation of the dollar, a real depreciation. And if it gets too tight, then you might find the interest rates rising in the U.S. But I doubt that Bernanke is going to raise interest rates. So the whole issue as to what the American growth rate is going to be fundamentally depends on what the Fed signals on interest rates. And at the moment, they're signaling a low interest rate. So Greenspan's predictions could really just sit comfortably. But I think it's better to reevaluate this in the first quarter 2010 to see exactly how the slide in the dollar is affecting American competitiveness.
How long do you think can global central banks afford to keep expansive policies in place?
Jennifer, I suspect that they're going to keep these expansive policies in place for two things. One, until they note that inflation is embedded in the economy. Once inflation is embedded, they might have to consider some exit strategy. But the earliest that we'll see exit strategies will be Canada, June G20 meeting. That'll be the earliest. So it'll be the summer of next year before we can even think about exit strategies. And until then, the main indicator is to watch the inflation numbers in all the world's economies.
Will the sharp increase in global debt levels drive up inflation over the medium to long term?
It could. It depends how this debt is going to be leveraged and handled. I mean, there's a lot of debt in the world. I mean, if you think of the American debt alone, the total public debt in the U.S. is the equivalent of 82% of American GDP. So that debt has to be handled in a way that can not constrain the actual growth in the economies. But yes, it could be a major factor in 2010. But what I'm looking at really is the whole issue as the movement of interest rates and whether or not inflation is actually embedded in the economy.
Well, on that note, thanks very much indeed, Patrick, for always dropping by the show whenever you're in Singapore. Dublin-based Patrick McNutt from the Manchester Business School and from the Business Desk. I'm Jennifer Alejandro.